Imagine you wake up one morning, walk to your bank, and find out you can no longer move your own money out of the country. Not because you did anything wrong, not because there's a war knocking on your door, but because the government decided overnight that your money belongs to Russia first and to you second. That moment is not a scene from a dystopian film. That moment is already happening, right now, in 2025, in one of the most powerful countries on earth. And the people living inside it are only beginning to understand what that truly means. This is the story of a financial system quietly cracking from the inside. This is the story of a government that is printing control while printing money. This is the story of an elite class running for the exit, and a Kremlin that is locking the doors behind them, one law at a time. This is Moscow's silent panic, and it started long before most people noticed. When Russia launched its full-scale invasion of Ukraine in February 2022, the world responded with something that had never been attempted at this scale before. Within days, Western nations froze approximately $300 billion in Russian sovereign assets held abroad. They cut Russia's largest banks off from the global SWIFT payment system. They sanctioned hundreds of Russian individuals, companies, and government entities. And the message was clear. The financial walls of the world were closing in on Moscow. But here is what almost nobody talked about at the time. The biggest threat to Russia's financial stability was not coming from outside. It was coming from within. In 2022 alone, capital outflows from Russia reached an estimated $232 billion. To put that number into perspective, that is more than the entire annual GDP of countries like Portugal, New Zealand, and Hungary in a single year. Gone. And it did not stop there. The money kept moving, quietly, persistently, through pathways that are hard to track and even harder to stop. So where did this money go? The answer tells you everything about how Russia's elite view their own country's future. Wealthy Russians rushed to move funds into real estate in Dubai, Istanbul, Yerevan, and Tbilisi. They poured money into cryptocurrencies and digital assets that exist outside government reach. They offshored dividends through shell companies registered in the UAE and Hong Kong. They used Turkish banks as relay stations, moving rubles into dollars into accounts that Moscow could not touch. And when those routes got complicated, they found more creative ones. Now, the capital did not disappear. It simply left. The Kremlin watched this happening and made a choice. It did not choose transparency. It did not choose reform. It chose control. And that choice set in motion a chain of financial decisions that Russia is still living inside today. And that is slowly reshaping what it means to own money in that country. The Central Bank of Russia was the first institution to show just how far that control would go. Before the war, Russia's central bank operated like most modern central banks. It targeted inflation. It adjusted interest rates. It let the ruble float on currency markets. It behaved more or less like an institution that respected the basic rules of economic gravity. After February 2022, all of that changed. What emerged in its place was something that economists would later describe as a hybrid regime, a system mixing interest rate policy, mandatory currency conversion rules, and direct capital controls into something that had no real name because it had never quite existed before. Some researchers began calling it constraint targeting, and the name fits perfectly, because the goal was no longer just to manage inflation. The goal was to manage everything. Here's how it worked. Exporters, the companies selling oil, gas, metals, and grain to the outside world, were ordered to convert their foreign currency earnings into rubles. Not asked, ordered. If a Russian energy company received payment in dollars for a shipment of crude oil, it had to sell a significant portion of those dollars on the domestic market and take rubles in return. This created a forced artificial demand for the ruble. It kept the currency from collapsing. It looked on a chart like the ruble was holding its value. But stability built on compulsion is not the same as stability built on confidence, and that distinction matters enormously for what came next. Citizens faced their own version of this control. Russians with bank accounts were placed under strict limits on how much money they could transfer abroad each month. For ordinary residents, the ceiling was set at $1 million per month via banks, and just $10,000 per month via money transfer systems. For most Russians, that sounds like more than enough. But for the business class, for the people who had spent decades building wealth and moving it internationally, those limits felt like walls going up around them, and the walls kept getting taller. Then, in October 2025, something happened that sent a chill through the Russian financial community that had nothing to do with winter. Russia's finance ministry put forward a proposal, a draft law, that would hand President Vladimir Putin sweeping and essentially unlimited powers over foreign currency transactions made by Russian residents. The proposal was not a small regulatory adjustment. It was a structural power grab. Under its terms, the president would gain authority to ban or restrict any foreign currency transaction by any Russian citizen or company at any time, for any reason he deemed appropriate. He would have the power to decide who could open foreign bank accounts and who could not. He would have the power to freeze international financial movement at will, not through the courts, not through parliament, but through executive decree alone. The bill passed, and the moment it passed, it changed the nature of owning money in Russia forever. Think about what that actually means. Every Russian with savings, every Russian business owner, every oligarch who thought they had diversified their wealth just enough to stay safe, all of them woke up on the day that law passed knowing that their financial freedom now existed only at the pleasure of one man. One signature could take it. One bad day in the Kremlin could trigger a freeze. One political disagreement, one wrong conversation, one moment of public disloyalty, and the money stops moving. That is not a financial system. That is a leash. And yet, the controls kept tightening. The central bank maintained an extraordinarily aggressive interest rate throughout 2024 and into 2025, pushing its key rate to 21%, one of the highest in Russian peacetime history. The idea was to cool inflation, which had been running hot due to war spending and supply chain disruptions. But 21% interest rates do not just cool inflation. They freeze investment. They choke credit. They make it almost impossible for ordinary businesses to borrow and grow. Russia's fixed investment began to contract. Companies stopped expanding. Entrepreneurs stopped taking risks. The economic engine, already under pressure from sanctions, began running slower and slower. The Bank of Russia eventually began cutting rates in mid-2025, reducing the key rate from 21% down toward 16% across 5 cuts. But even at 16%, the borrowing environment remains punishing, and the cuts themselves tell their own story. They were a signal that the Kremlin knew it could not sustain the pressure it had created. The economy was not just under external attack from sanctions, it was being strangled by its own monetary policy, and the people who understood this best were already preparing to leave. That brings us to one of the most revealing and disturbing aspects of this story, the exit bans. If capital flight is Moscow's financial panic, exit bans are its physical equivalent. And in 2025, they became a weapon used with increasing frequency against Russia's own business elite. In June 2025, Konstantin Stukov, the CEO of Ural Gold, a major metallurgy and mining conglomerate, arrived at a Russian airport ready to board his private jet. He had done everything right, or so he believed. He had stayed in Russia. He had continued running his business. He had not publicly criticized the government. But when he reached the runway, officers boarded his aircraft. His name was on a list. He was not permitted to leave. No public explanation was given. No charges were announced. He simply was not allowed to go. The story spread through Russia's business community like a cold wind. If Stukov, a man of that stature, running a company that important, could be stopped at the runway without warning and without explanation, then who was truly safe? The answer, whispered in Moscow boardrooms and private WhatsApp groups, was nobody. Nobody with real money, real influence, and any conceivable reason to leave was safe from an exit ban. And that realization accelerated something already in motion. It made the remaining elite more desperate to move assets before the next law passed, before the next name ended up on the next list, before the next jet was stopped on the next runway. The Kremlin did not just use exit bans against private citizens. It used the same logic against foreign companies trying to leave Russia. After the invasion, hundreds of Western corporations began the painful process of exiting the Russian market. McDonald's sold its Russian operations. IKEA closed its stores. Shell, BP, Renault, and dozens of others tried to wind down their Russian presence. But the Kremlin made clear, and Kremlin spokesman Dmitry Peskov confirmed publicly, that there could be no free exits. Companies wishing to leave Russia would do so on terms set by a special government commission. They would be forced to sell assets at steep discounts, often as low as 50% of market value. They would pay exit taxes of up to 15% on top of that, and they would wait, sometimes months, sometimes longer, for approvals that might never come. The message embedded in all of this is worth reading carefully. Capital that entered Russia was welcome. Capital that wanted to leave Russia was a problem. And problems, in the Kremlin's current framework, were solved not with market mechanisms, but with political force. Now here's where the story gets almost paradoxical. Because in the middle of all this panic, all these controls, all this pressure and fear and capital flight, the Russian ruble ended 2025 as one of the top performing currencies in the entire world. Let that land for a moment. A currency operating under the most severe sanctions regime ever imposed on a major economy, backed by a central bank charging 21% interest, governed by mandatory conversion rules, and supporting a war economy. That currency outperformed almost every other currency on Earth in 2025. How? The answer is not confidence. The answer is not strength. The answer is engineering. The mandatory conversion orders forced exporters to flood the domestic market with foreign currency, creating artificial demand for rubles. The capital controls prevented ordinary Russians from selling rubles to buy dollars or euros or yuan, which would have pushed the ruble lower. The high interest rates made holding ruble-denominated assets technically attractive, at least on paper. The ruble's apparent strength was not a sign of economic health. It was a sign of how completely the Kremlin had taken over the mechanisms that normally determine a currency's value. And then, in August 2025, something small happened that revealed exactly how artificial that strength had been. The government relaxed the mandatory foreign currency conversion requirements for large exporters. It did not eliminate them entirely. It simply loosened them slightly, and the ruble began to weaken. By late 2025, the exchange rate had moved to approximately 84 rubles per dollar. Not a collapse, not a crisis, but a reminder that the ruble's apparent stability was dependent entirely on constant government intervention. Remove the hand holding it up, and it drifts down. That is not a strong currency. That is a managed illusion. The trade architecture of Russia has also transformed in ways that tell the same story from a different angle. Before February 2022, roughly 80% of Russia's international trade was conducted in dollars and euros. Today, that share has collapsed dramatically. Nearly 60% of Russian exports are now paid in rubles, compared to just 14% before the invasion. Trading in Chinese yuan has grown substantially. The dollar, once the invisible backbone of Russian international commerce, now barely registers in many of Russia's key trade relationships. This sounds like diversification. It sounds like Russia adapting and finding new pathways. And to some extent, it is. And right now, the honest answer is maybe not. And maybe not is not good enough for anyone making a serious long-term investment decision. There is also the matter of what these controls are doing to ordinary Russian financial behavior. Russians who have lived through the 1998 ruble crisis, through the 2008 global crash, through the 2014-2015 sanctions episode, are not naive about financial instability. They have watched currencies collapse before, they have seen savings wiped out before, and the behavior patterns they have developed in response, storing cash at home, buying durable goods as a hedge against inflation, holding foreign currency in physical form when possible, are all reasserting themselves. The central bank's own surveys have shown rising demand for cash among ordinary Russians, not because the economy is growing, but because people do not fully trust what is happening inside the banking system. When your government is claiming the right to restrict your own transactions by executive decree, a certain amount of mattress banking starts to feel rational. And here is something that rarely makes international headlines, but matters deeply for understanding the full scope of this crisis. The ruble-dollar trading pair, the basic market exchange between Russia's currency and America's, has collapsed by 96% compared to pre-invasion levels. Not 96% of the value, 96% of the volume. The sheer number of trades, the daily activity, the liquidity that makes a currency market function, all of it has almost entirely vanished. What remains is a relic of a market. A thin, heavily managed channel where the central bank has its finger on the scale at all times, where the prices that result bear little relationship to what a free market would actually produce. Russia's currency market is no longer a market in any meaningful sense. It is a performance. And the audience, ordinary Russians watching their savings hold their nominal value, is being asked to applaud a show whose backstage mechanics they are not allowed to see. The sanctions architecture that made all of this necessary is also worth examining, because it has evolved in ways that keep tightening the vice. After 2022, the primary round of sanctions removed Russia from SWIFT, froze sovereign assets, and targeted key individuals and entities. But by 2024 and 2025, a second wave of secondary sanctions had begun targeting third-party countries and companies that were helping Russia circumvent the primary restrictions. The banks in Turkey, the UAE, China, and Central Asia that had been processing Russian transactions found themselves facing the threat of being cut off from the US dollar system if they continued. Many began pulling back. The channels that Russian capital had been using to escape quietly began narrowing. The escape routes were not closed entirely, but they became more expensive, more complicated, and more visible. And visibility, for capital that is trying to move without being noticed, is the enemy. The human cost embedded in these numbers is easy to miss when you are looking at balance sheets and interest rate charts, but it is there. Russia lost somewhere between 500,000 and 800,000 working-age people in the emigration wave of 2022 alone, according to various estimates. Many of these were not oligarchs. They were software engineers, doctors, architects, teachers, scientists, exactly the kind of skilled professionals whose departure hollows out an economy's productive capacity from the inside. The IT sector in particular was devastated. Tens of thousands of Russian technology workers relocated to Georgia, Serbia, Armenia, and the Baltic states in the months following the invasion. Entire tech companies relocated their operations, keeping their Russian employees but moving their legal and financial structures out of Russia entirely. The servers left, the intellectual property left, the future earnings of those companies left, and none of it appeared in any single dramatic headline, because it happened gradually, One visa application at a time, one telegram announcement at a time, one quietly emptied office at a time. The geopolitical dimension of all this makes it harder to see a near-term resolution. Russia's financial isolation is not just an economic condition. It is now woven into the political architecture of the war. Sanctions relief, the thing that would most directly ease the capital controls, restore some access to Western financial systems, and create conditions where investment might conceivably return, is not on the table as long as the war continues. And the war shows no clear sign of ending on terms that would satisfy both sides. Russia cannot easily reverse course on the financial controls it has built without the Kremlin losing face and signaling weakness. The West cannot easily lift sanctions without appearing to reward military aggression. So both sides remain locked in their positions, and Russia's financial system continues to evolve under the pressure of a condition that has no obvious exit point. The irony that haunts all of this is that Russia is a country of genuinely vast natural wealth, the largest territory on Earth, enormous reserves of oil, natural gas, coal, rare earth minerals, timber, freshwater, and agricultural land, a well-educated population, a tradition of scientific and engineering excellence, a history that includes genuine moments of rapid industrial and technological development. None of that has gone anywhere. The resources are still there. The people are still there. But the conditions required to convert those resources and that human potential into sustainable economic growth, rule of law, secure property rights, free movement of capital, trust in institutions, those conditions are being systematically dismantled in the name of national security and wartime necessity. The tools of control being built today will not disappear when the war ends. They will still be there. They will still be available to be used. And the institutional habits being formed, the habit of restricting, monitoring, controlling, confiscating, will be very hard to unlearn. There is a concept in economics called credible commitment, the idea that a government's promises and policies are only as powerful as the belief that they will actually be honored. When a central bank says it will keep inflation low, businesses and consumers make decisions based on that promise. When a government says it will protect property rights, investors put money into the country based on that guarantee. But there is a darker side to this shift that is easy to miss. Trading in yuan rather than dollars gives China enormous leverage over Russia's economic fate. Every major ruble-yuan transaction passes through Chinese financial infrastructure that Beijing ultimately controls. Every energy deal settled in yuan rather than dollars is a deal where China holds the terms. Russia has not escaped dependence on foreign financial systems. It has simply traded Western financial dependence for Chinese financial dependence. And unlike the West, China has shown no particular interest in protecting Russian economic sovereignty. China is interested in cheap Russian energy, in favorable trade terms, and in having a large nuclear-armed neighbor that owes it favors. That is a very different kind of partner than what Moscow imagined when it began pivoting east. The broader economic numbers make this picture even more sobering. Russia's GDP growth was forecast at just 1% for 2025 and 3% for 2026. In a country spending this much on military operations, borrowing this heavily and mobilizing this much of its economic capacity for war, growing at 1% is not a success. It is barely treading water. And beneath that headline number, the structural problems are deepening, fixed investment is contracting. The federal budget is projected to remain in deficit through 2028. The 2026 deficit alone is estimated at roughly 5 trillion rubles, which works out to about 6% of GDP. Russia is spending money it increasingly does not have on a war whose end date no one can predict, while the very people who generate the private economic activity that produces tax revenue are either leaving, hiding their assets, or quietly reducing their exposure to Russian financial risk. That last point deserves more attention than it usually gets. When wealthy people and productive businesses move their assets out of a country, they are not just moving money. They are moving the future tax base. They are moving the investment capital that would otherwise fund new factories, new technology companies, new logistics networks. They are moving the human judgment, the entrepreneurial risk-taking, and the long-term economic vision that cannot be replaced by government decree. Russia is not just losing the money that has already left. It is losing the money that would have been created by the people who left. That is a compounding loss. It gets larger every year. And it is very, very difficult to reverse. The December 2025 decision by Russia's central bank to partially lift some international transfer limits for residents of friendly countries looked, on the surface, like a small relaxation of control. And, in the narrowest technical sense, it was. Previously, individuals could transfer up to $1 million per month through banks and $10,000 per month through money transfer systems. The December change eased those restrictions somewhat for citizens of countries Russia considers allied or neutral. The media framing around the announcement emphasized openness and flexibility, but read it carefully, read it again. The change applied only to friendly countries. It left the restrictions in place for everyone connected to the Western financial system. It was not a signal of liberalization. It was a recalibration, tightening the boundaries around the West while slightly loosening them toward China, Central Asia, and the Middle East. It was drawing the walls of Russia's financial world in a new shape, not removing the walls, redrawing them. Meanwhile, the shadow economy around capital flight has become remarkably sophisticated. Wealthy Russians have developed entire networks to move money in ways that official statistics struggle to capture. Under-invoicing of exports is one method. A Russian company sells oil to a buyer in a friendly third country at a deliberately low stated price, and the difference is paid into an offshore account that never appears on any official Russian balance sheet. Debt write-offs are another. A Russian company loans money to a foreign subsidiary. The subsidiary never repays it, and the money is effectively transferred abroad without triggering currency controls. Cryptocurrency has become a significant channel, particularly privacy coins and peer-to-peer transfers through platforms that operate outside regulated financial systems. And the physical smuggling of cash, actual banknotes moving across borders hidden in luggage, vehicles, and commercial shipments, has reportedly increased significantly since 2022, though by its nature it is almost impossible to measure precisely. The destinations for all of this capital tell their own story about Russian elite psychology. Dubai has become perhaps the most visible hub. Real estate purchases by Russian nationals in the UAE surged dramatically after 2022. The city's real estate market, already one of the most opaque in the world, became a favored destination for funds that needed to exist somewhere respectable, somewhere stable, somewhere that asked few questions and provided luxury in return for capital. Istanbul served a similar function, particularly in 2022 and 2023. Georgia, Armenia, and Kazakhstan became transit economies, processing Russian money moving toward other destinations. Singapore and Hong Kong became favored for more sophisticated financial structuring. And in each of these places, the Russian money arrived quietly, moved quickly through legal and semi-legal channels, and settled into assets that were very difficult for the Russian government to identify, let alone reclaim. The Kremlin knows this is happening. The legislation is the proof, the exit bans are the proof. The October 2025 currency control proposal is the proof. A government that was not worried about capital flight would not be spending this much political and legislative energy trying to contain it. The very ferocity of the controls is a measure of the scale of the problem they are trying to address. You do not build walls this high unless you're genuinely afraid of what is on the other side of them. And yet the walls create their own problems. Every new restriction that makes it harder to move money out of Russia also makes it harder to attract money into Russia. Foreign investment, already decimated by sanctions, does not return to a country where the government claims the right to freeze your transactions at will. Entrepreneurs who might otherwise build businesses in Russia, even Russian entrepreneurs living abroad who might consider returning, look at the legal architecture being constructed and ask themselves a simple question. If things go wrong, can I get my money out? When a legal system says it will treat citizens fairly, people participate in the economy based on that faith. Russia has spent the last 3 years systematically destroying its credible commitment on almost every dimension of economic governance. The promise that you can own property freely, broken. The promise that you can move your money across borders, conditional at best, revocable at worst. The promise that the law will not be used as a political weapon against you simply for being successful or for being perceived as a potential immigrant. That promise is no longer made at all. When credible commitment collapses, the damage compounds. Because every decision made in uncertainty, every investment not made, every business not started, every talent not retained, creates a smaller economic base from which the next round of uncertainty flows. Every country that has gone down this road has discovered the same truth eventually. You can control capital for a while. You can force it to stay, force it to convert, force it to sit in assets it would never freely choose. But you cannot force it to be productive. You cannot force it to innovate. You cannot force it to create the kind of long-term value that actually builds a strong economy. Controlled economies survive. They rarely thrive. And the gap between surviving and thriving is where ordinary people, not oligarchs, not officials, not Kremlin insiders, pay the price in lower wages, in worse healthcare, in less economic opportunity for their children, in a future that is smaller than it should have been. The silent panic of Moscow's financial system is not a panic that looks dramatic from the outside. There are no bank runs in the streets. There are no ATM queues stretching around the block. The stores are stocked, the lights are on, the official statistics report modest growth. And that is precisely what makes it so significant. Because the real damage is happening in the invisible layer of economic decision-making, in the entrepreneur who decides not to start that business, in the investor who redirects capital away from Russia quietly, without announcement, in the executive who waits in a foreign city and does not book a return ticket, in the ruble that holds its value only because the hand holding it refuses to let go, in the law that gives one man the power to freeze the financial life of any Russian citizen at the moment of his choosing. These are not small things. These are the building blocks of a system that is becoming harder and harder to exit, not just physically, not just financially, but conceptually. A system where the rules change without warning, where control is the answer to every question, where the price of stability is the surrender of freedom, not all at once, not with a single dramatic announcement, but gradually, methodically, law by law, decree by decree, runway by runway. The money that has already left Russia will not come back easily. The trust that has already been lost will not be rebuilt by lifting a single restriction or passing a single reform. The capital that fled through Dubai and Istanbul and Tbilisi and Hong Kong is parked in places with warm climates, clear legal systems, and no exit bans. It is not sitting in a waiting room hoping for conditions to improve. It is building a new life somewhere else. And the longer that continues, the more Russia's economic future depends on resources it cannot export freely, an alliance with China that operates entirely on China's terms, and a domestic financial system that functions as an extension of political power rather than as a servant of economic growth. And that is the final truth that this story keeps returning to, no matter which angle you approach it from. The panic in Moscow is not just about money leaving. It is about meaning leaving. When people with options choose to move their assets, their families, and their futures out of a country, they are not just making a financial calculation. They are making a judgment about what kind of place that country is becoming. They are voting with their wealth on the question of whether they believe in the future being built around them. And right now, in 2025 and into 2026, that vote is going one way. Quietly, persistently, expensively, out. Moscow's panic is silent, but it is real. Or in the laws, in the numbers, in the exit bans, in the mandatory conversions, in the ruble's manufactured strength, in the finance ministry proposals that treat every Russian savings as a strategic reserve belonging first to the state. The silence is not the silence of calm. It is the silence of a system holding its breath, waiting to see if the walls it is building are high enough to contain what is trying to get out, waiting to discover whether control, applied relentlessly and without limit, can substitute for the thing it has already lost, the thing that no law can manufacture, the thing that no decree can restore, the thing that is called, in economics and in life alike, by its simplest and most powerful name, trust. And right now in Moscow, trust is the one thing that money cannot buy, because the money already left.